There are a lot of $100 bills in circulation. Warren Buffett wondered where they were. We looked into it. By most measures, inflation has been tamed in 2025. Politicians blame each other for causing it and take credit for reducing it. It's of course not quite that simple. Inflation happens when the money supply increases relative to the value of goods and services that a country produces. In 2020, the COVID pandemic affected the world economy in an unprecedented way. It became necessary to limit personal interactions in an effort to reduce the spread of the horrible disease. This had the effect that the world economy, which was buzzing along quite nicely up to that point, would slow down in a very unnatural way. To compensate for this, the governments of the world sent approximately $12 trillion in relief funds to their citizens and businesses. In the United States, prior to the pandemic, there was $14 trillion in circulation. After the relief was issued and the other deficit spending was added, there was $21 trillion in circulation. People felt like they had 50% more money. That increase in the money supply caused inflation. As people receive the relief funds, they feel a little wealthier. They spend those funds just a little more willingly. This increases demand for goods and services. Now, because the economy had been shut down, there were fewer goods and services available to meet the demand, and prices increase. But then people were willing and able to pay even more. So this caused prices for existing goods and services to further increase, and voila, inflation. Some of that new money took the form of larger bank accounts, reduced balances on credit cards, or just simply entries in accounting systems. But a lot of it is actual printed cash. Economists keep track of money in an overwhelmingly confusing number of ways. There's the monetary base, MB. There's M0, M1, M2, and M3. And of course, MZM, which is a measure of the most liquid components of M2. Each measures something a little bit different. But the one thing they all have in common is that they all include the paper money and coins that are in circulation. The currency in circulation is the topic of this article. According to the United States Treasury, there is $2.3 trillion in paper money in circulation. Only $14.5 billion of that is dollar bills. Not entirely surprisingly, the value of $100 bills exceeds the value of $1 bills, but what I found fascinating is the number of $100 bills in circulation. There are more $100 bills in circulation than $1 bills. In fact, there's 4.5 billion more hundreds than singles. That amounts to 1.9 trillion worth of $100 bills. That's 82% of all the US money in circulation. So where are all those $100 bills? Well, I certainly don't have them. When I'm feeling particularly wealthy, I like to keep 2 or 3 in my wallet. And invariably, after I've impressed only myself, then I spend them, and then I no longer feel wealthy and return to using plastic. By the way, 190 million Americans have 800 million cards. Each year we use those cards to process $10.7 trillion in transactions. This figure is slightly more than a third of US GDP. Cash transactions, somewhere between 2.1 and 2.9 trillion, account for only 12 to 16% of total spending. Americans seem to prefer plastic money, but cash remains important. The U.S. Federal Reserve estimates that 50% of all U.S. currency by value is in circulation abroad. In a 2018 report, the Federal Reserve Bank of Richmond estimated that more than 2/3 of all of the $100 bills, that's nearly $1 trillion worth, are kept overseas. Ironically, the Federal Reserve still honors all of the $100 bills that have ever been printed. The $100 bill was first authorized in 1914 in the Federal Reserve Act. At the time, a $100 bill was worth 3,156 of today's dollars. Holding one as cash would of course not produce any return on investment. But if that bill were deposited in a savings account at a regular bank that somehow survived 1929, it would be worth $1,561 today. If your great-grandparents had used it as a 10% down payment on a modest suburban home, you would now own their modest $320,000 home today. Had they invested it in 100 shares of the Coca-Cola Company, they could have left you a cool $20 million inheritance, Or if they had just hid that $100 bill at the bottom of their underwear drawer until you found it in 2009 when you might have used it to buy 131,000 bitcoins, your $13.6 billion net worth today would be approaching 3.5% of Elon Musk's wealth. No, you would not be like all those people outside the United States holding $1 trillion worth of $100 bills. Those are still worth the same $100 as the day they were printed. It cost the Treasury about 14 cents to print a $100 bill. When consumers demand $100 bills, it's effectively an interest-free loan to the Federal Reserve. The paper money is given in exchange for a debit to the requester's account. The holder of the $100 bill then has the note that they can return to the bank in exchange for a credit to their account. Until that happens, the $100 bill in circulation represents a liability on the balance sheet of the Federal Reserve Bank. Paper currency represents 36% of the total liabilities on the Fed's balance sheet. And most of that obligation is $100 bills. Between 2014 and 2022, the European Central Bank was offering negative interest rates to its depositors. So this took the form of fees that ranged as high as 0.75%. European banks would gladly accept euros from depositors, charge them a fee to hold the cash, and then offer no interest. The depositors would have done better to just rent space in a vault and store their euros until the situation improved. But the negative interest rates were exerting downward pressure on the value of the euro relative to the dollar. In other words, dollars were holding their value better than euros. Dollars were simply a superior store of value. But how exactly would someone outside the United States get a large quantity of $100 bills to store? They would have to find a bank that had an account with the Federal Reserve Bank of New York and make deposits sufficient to cover the cost of the paper currency plus any fees. They must also meet the strict rules of the Currency and Foreign Transaction Reporting Act, commonly known as the Bank Secrecy Act of 1970. This law requires banks, as well as broker-dealers and advisors, to establish anti-money laundering AML processes to detect and prevent money laundering. They must maintain records for any transactions that exceed $10,000 and file suspicious activity reports for any questionable transactions. The BSA also requires that financial institutions know their customers in a requirement known as KYC. To comply, institutions must collect identity information, verify it, and check those identities against sanction lists. The Patriot Act further strengthened the BSA. Then in 2020, the Anti-Money Laundering Act modernized the BSA, increasing penalties, protecting whistleblowers, and requiring reporting to the U.S. Treasury's Financial Crimes Enforcement Network, FinCEN. With AML and KYC satisfied, the order is then placed for the currency, and the purchase transaction would be completed electronically. The Fed then contracts with a specialized shipping carrier experienced with handling high-value cargo to ship the physical currency. Finally, the currency is delivered. The recipient must then accept and protect it. There are many interesting stories of smugglers moving cash out of the U.S. In 2020, customs agents in Miami seized $491,000 hidden in a chair. In 2015, 3 Texans were caught with $383,000 hidden in a false pickup truck bed. And between 2004 and 2007, Wachovia Bank accepted transfers of $378 million based on U.S. currencies smuggled out of the U.S., then deposited in Mexican banks for the Sinaloa cartel, the El Chapo gang, among others. This cash was mostly repatriated before the scheme was exposed. In the 1990s, Jordan Belfort, the Wolf of Wall Street, orchestrated the smuggling of $20 million to Switzerland, with as much as $300,000 strapped to one individual. None of this activity accounts for all of the $100 bills that are no longer in the United States. There is much speculation about where the money is, and no one really knows for sure. What we do know is that since 1990, approximately $700 billion has been legally exported. Our probe into the international flow of U.S. currency would not be complete if we didn't look into the conspiracy theories that pallets of cash are flown overseas to be used allegedly by the CIA as bribes and to influence foreign governments. In 2013, the New York Times reported that between $100 and $200 million was used in Afghanistan in the ghost money operation to buy influence and support anti-Al Qaeda activities. Since 1990, however, the total amount that the CIA might have used is likely less than $5 billion, which is only a small fraction of the money in question. Our best estimates are that Mexico has between $20 and $40 billion. Russia and Eastern Europe is holding between $50 and $80 billion. Africa has at least $50 billion, but potentially as much as $100 billion. Argentina alone holds between $100 and $200 billion in U.S. currency. Venezuela definitely holds U.S. currency as an inflation hedge against their unstable currency. The Middle East holds somewhere between $100 and $200 billion, and Asia is by far the largest holder of U.S. currency with between $300 and $400 billion. So as the world's reserve currency, dollars are required for many international transactions. While it's unlikely that much legitimate business is being conducted through the exchange of suitcases full of $100 bills, it is likely that pallets of $100 bills are stored in private vaults all around the world. You might be wondering, if this money were suddenly repatriated, would it cause rampant inflation? Well, probably not, because if the money were legally returned, the Fed would just take it out of circulation. This would prevent inflation because the GDP and the money supply would remain in relative equilibrium. All of this U.S. currency being held abroad does raise a few risks for the U.S. First, there's seigniorage. Technically, that's the difference between the $99.84 profit that the government makes when it sells a $100 bill that costs only 14 cents to print. This profit is earned as soon as the bills go into circulation, but the government expects that money to also stimulate the U.S. economy. And if the money is expatriated, then the ongoing economic stimulation from subsequent transactions will benefit the offshore economies, not the U.S. There's also a phenomenon known as dollarization. This occurs when countries with unstable economies, such as Venezuela and Zimbabwe, rely entirely on U.S. currency. According to the International Monetary Fund, the IMF, 59% of global exchange reserves are U.S. dollars. According to SWIFT transaction data, 88% of international transactions are conducted in U.S. dollars. The dollar is unquestionably the world's reserve currency. Virtually anyone wanting to conduct international transactions will require some form of dollars to do so. There is an effort from an organization known as BRICS to de-dollarize international transactions. BRICS is an acronym that stands for the member countries: Brazil, Russia, India, China, and South Africa. In their combined national interest, they seek alternatives to the US dollar as the world's dominant currency. Interestingly, a number of the member countries are the target of ongoing US sanctions. BRICS was formed nearly 20 years ago and has expanded to include Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. BRICS represents 42% of the world's population, but only 27% of the global GDP. BRICS has proposed a new currency called the unit. The unit would be backed by gold or some economic basket of alternative precious commodities. Many experts view the unit as a flawed idea due to the diverse economies of BRICS nations, which could lead to instability and default dependence on the Chinese yuan as the world's second most powerful currency. No launch date has been set, and progress remains purely conceptual. With the recent successes of the U.S. military, there is justified world confidence in the dollar. So in summary, more than $1 trillion of $100 bills are in circulation outside the United States. The majority of the $100 bills are being held in Asia and Latin America. This creates a de facto interest-free loan to the U.S. government, saving approximately $80 billion a year in interest payments. U.S. currency creates global trade liquidity. It stabilizes economies in crisis regions by acting as a safe haven asset. A lot of it facilitates illicit activities. Foreign circulation of U.S. currency contributes to the trade imbalance by strengthening the dollar. For the foreseeable future, the U.S. dollar will remain the reserve currency for the globe and will remain its financial safe haven. The U.S. financial markets represent more than half of total global wealth, while the U.S. represents only 4.2% of the population. The U.S. is the globe's financial powerhouse and will remain so for the foreseeable future. To learn more about alternative investments and building the world's future technology companies, visit www.polynomial-vc.com.